1.2.1 says we bought equipment on credit for 10,000 Rand from Twanes Furnishers. What I'm going to do is I'm going to make my notes here. First, let's quickly draw this. Assets increases on this side and decreases on that side. Owner's equity decreases here, increases there. Liabilities decreases there, increases there. Remember, the left side is a debit and the right side is our credit side. So this is debit, this is credit, this is debit, this is credit. Okay, so let's go. We bought equipment on credit for 10,000 Rand. So 2 accounts involved. I'm going to write them down. So my first account is I bought equipment. So I bought equipment. So equipment is my first account. And then I bought that on credit. So creditors control is my second account. Now what I'm going to do with this is I'm first going to classify the accounts. So equipment is an asset. Okay. So there. So equipment is an asset. And creditors control is a liability. Okay. Then I'm going to ask myself, if you buy equipment, does your equipment get less or more? Your equipment gets more. And if you buy on credit, does the business owe more money or owe less money? The business will owe more money. So that's a plus. Then I'm going to look at these tables over here. Quickly going to check. Let's look. An asset has a plus on the debit side. Okay. So let's write that down. So this account will be debited. And the liability has a plus. Look here on the credit side. So that account will be credited. And the amount is 10,000 Rand. So let's go fill this in. So, okay, we're going to fill this in. Account debited. So account debited is equipment. Oh, it is there. Do you see they already put that down for you? And then account credited is creditors control. So here I can write creditors control. Then the amount is 10,000. And then assets will get a plus. So a plus. And liabilities will get a minus. No liability, and liabilities will also get a plus. So plus and owner's equity is not involved. And there you have your first transaction. You must just know that a 0 plus 10,000 will give me this answer here. So that's how you know you're also right there. Okay, let's look at our next adjustment, 1.2.2. It says a debtor in Motusi, so a debtor, paid us 4,750 via EFT. So that's cash, in settlement of an account. But the account was for 5,000 Rand. Okay, so 2 things happened here. A debtor paid us and we allowed a discount because there's a difference between these 2 amounts. That difference is 250. That 250 is the discount we allowed. Now we have 4 accounts involved. So 1, 2, 3, 4 accounts. Let's write them down. So when the debtor pays us, the accounts involved are bank and debtors control. Okay? And then when we allow a discount, so whenever you allow a discount to a debtor, it's discount allowed, and debtors control. Okay, now we're going to classify the accounts. So let's write what kind of account are these. Bank is an asset. Debtors control is an asset. Discount allowed is an expense. So it falls under owner's equity. And then debtors control again is still an asset. Okay, let's go. Make a little arrows. Plus or minus. Let's look at the bank. If a debtor pays me cash, I have more money in my account. Plus. Okay? If a debtor pays me, we're looking at debtor's control. The debtor owes me less. So because the debtor is paying the account, they owe me less. Discount allowed, it's an expense, and an expense decreases owner's equity. So decrease. And then debtor's control, let's ask ourselves with regards to discount allowed, because they go together, yeah? If I allow a discount to my debtor, the debtor owes me less. Okay, so at least there's my pluses and my minuses. Okay, so now let's say account debited or credited. This is asset and a plus. Asset and a plus. Yes, asset and a plus. It's debited, So this account will be debited. Then asset and a minus. Yes, asset. And there's the minus. It's credited. So that account will be credited. So this account will be credited. Then owner's equity and a minus. Let's go look. Owner's equity and a minus. There's the minus. Debited. So debited. And then asset and a minus. Yes, asset. There's the minus. That's credited. Okay, so this is credited. Then remember these two, they go together. And then these two go together. Okay, the first two is the money you receive from the debtor. We receive 4,750, and these two are the discount allowed, that is 250. Okay, so let's write this in. Account debited, so account debited is bank. So account debited is bank, so account debited is bank. And then account credited is debtor's control. It's written there. And the amount there is 4,750. And let's put our pluses and our minuses. So we said an asset gets a plus. And here the asset gets a minus. So this one will have a plus and a minus. So this one will have a plus and a minus. 0, 0. Okay. Then the other two accounts, discount allowed will be debited. So this is discount allowed. And debtor's control will be credited. And the amount there for the discount is 250. Owner's equity is a minus. The owner's equity is a minus. And assets is a minus. This is a 0. Okay, and there you've done that transaction. Let's go to the next one. Our next adjustment is 1.2.3. It says we sold goods for cash and the cost price is 3,000 Rand. When you sell goods, whether it's on cash or credit, you have 4 accounts involved. The first 2 accounts has to do with the selling price, and the other 2 accounts will have to do with the cost price. The first 2 accounts will go with the selling price, and the other 2 accounts, they will go with the cost price. So account number 1, we sold the goods for cash, so bank is involved, and then sales is involved. Okay, they will go with the selling price. Then cost of sales is involved, and trading stock is involved. These 2 will go with the cost price. Okay, let's classify the accounts. So let's classify. Bank is an asset. Sales falls under owner's equity. Cost of sales is also owner's equity, and trading stock is an asset. Okay, let's do pluses and minuses. Put our arrows. Okay, when you sell goods, because that's what happened. When you sell goods, in terms of your bank, will you get more money or less money? You will get more money, so plus. When you sell goods, does your sales increase or decrease? Your sales will increase. Cost of sales is an expense. So cost of sales will decrease owner's equity. Trading stock, if you sell goods, do you have more trading stock or less trading stock? You have less trading stock. Okay, let's do debit and credit. So bank is an asset plus, asset and plus debit. Can you see there? Asset. The plus is on the debit side. So this account will be debited. Owner's equity and plus. Owner's equity and plus is this side. So this will be credited. Cost, owner's equity and minus. Owner's equity and minus is this side. That's a debit. Assets and the minus. Assets and the minus is this side. That's a credit. Okay, and let's put the amounts down. So it says here you sold the goods and the cost price of the goods was 3,000. So remember I told you these two will go with cost price, eh? So 3,000 and 3,000. The first two will go with the selling price. So we have to work out the selling price. So selling price is equal to cost price times 1 comma markup. So cost price is 3,000, 1 comma. The markup is 50% on cost. So 50, and this will give me 4,500. So over here, this is going to be 4,500 and 4,500. Let's go to our table. Let's put this in. Bank will be debited. Okay, so under account debited, we must write bank. There it is. So that's done. And then sales will be credited. So now account credited is sales. And then the amount for these two is 4,500. Okay, so let's go. This is an asset and a plus. So we go asset plus. This is owner's equity and plus. Owner's equity plus, no liabilities. Then let's go here. Cost of sales will be debited. So under account debited, it's cost of sales. Already there. Trading stock will be credited. So let's go right in. Trading stock. Oh, they have the amount also there. Owner's equity minus assets minus liabilities 0. Okay, next adjustment. 1.2.4 says the owner took trading stock. So the owner took trading stock at the cost of 850 for personal use. Two accounts involved. Account number 1, trading stock. You can write any one of these down. It's either you start with trading stock or you start with drawings, eh? Okay, so the owner took goods for personal use. Those are my two accounts. Let's classify the accounts. Trading stock is an asset. Drawings is owner's equity. Okay, and then let's go on pluses and minuses. If the owner takes trading stock for personal use, do you have more or less trading stock as a business? You have less trading stock. And then drawings always decreases owner's equity. Okay, that's always the case, eh? So it's a minus and a minus. And it's always recorded at cost price. So the amount here is 850 for both of them. Okay, let's do debited and credited. So assets and a minus. Assets and a minus is on the credit side. So this will be credited. And then owner's equity and a minus. Owner's equity and a minus is a debit. So this one will be debited. Okay, let's record this. So trading stock will be credited. Oh yeah, you see trading stock is already there. So we don't have to put that in. And drawings will be debited. So let's go put debited in. Drawings will go here. Then assets will have a minus. Assets will have a minus. Owner's equity will have a minus. And liability 0. We're done with that one. On to the last adjustment. Okay, our last adjustment says 1.2.5. The owner of the business returned damaged goods to the supplier. They were discounted at 5%. The original cost price is 1,800. Okay, so we are returning goods to the supplier. Now, a supplier is always creditor's control, eh? But it's now discounted by 5%. So let's quickly work out the amount. So first I'm going to work out what's 5% of 1,800. And that is 90 Rand. So that's the discount. Okay. So now I'm just going to minus the discount from this. So I'm actually going to return it at this price. There we go. Two accounts involved. We are returning goods to a supplier. Supplier is creditors control, account number 1. And then we are returning goods, trading stock. So trading stock, let's quickly classify. Creditors control is a liability. Trading stock is an asset. Let's do pluses and minuses. If we return goods to our supplier, do we owe them more or less? We owe them less money because we're returning goods. And then if I return goods to a creditor, do I have more goods or less goods? I have less goods. Okay, now let's do debit or credit. Liability and a minus. Liability and a minus is this side. That's the debit side. So this is debit. Assets and a minus. Assets and a minus is this side. So that's credited. Creditors control is debited. Is it written in there for us? No. So this is creditors control. And then trading stock is credited. Okay, that's there. So that's done. So what can we do now to finish this off? Pluses and minuses. Liabilities get a minus. And then assets gets a minus. And this is 0. And the amount was this amount over here. 1,710. And there you've done the accounting equation or analysis of transactions. So that's all, great teens. Hope it makes sense.